And gold prices have rallied nearly 50% so far in 2025.
All-time highs in gold just about continues.
The price of gold, it has soared to over $4,000 an ounce for the first time ever. Gold
prices.
Is gold about to crash? Has it reached its tipping point? Does investing in gold even make any sense right now? With gold prices soaring like never before, these are the questions that have every investor on the edge. Gold has hit an all-time high, and that's not new. What's new is who is buying it and why this time feels different. For decades, gold has been called a safe haven, but lately it's behaving more like a quiet rebellion against inflation, against currencies, even against trust in the system itself. So let's unpack this properly. Why gold is rallying, what's really driving it, and whether it still makes sense to invest, especially when prices are at record highs. And by the end, we'll figure out how to invest smartly without falling for the hype. Let's start with the simplest question. Why is gold surging again? Most people think it's because retail investors are buying. But after digging deep into the data, our team found that the biggest buyers right now are central banks. In the last 5 years alone, central banks around the world have added more than 900 tons of gold to their reserves. One of the fastest accumulation streaks in modern history. But why exactly are they doing it? The answer is pretty straightforward. Because gold is the one asset that doesn't depend on anyone's promise to pay. In simple language, global debt is at $100 trillion. Currencies are under pressure and the dollar looks overextended. Central banks are turning to something real. They're getting nervous that this debt might become a problem and resorting to the so-called safe haven. Sovereign and corporate borrowing has nearly tripled than what it was right before the 2008 financial crisis. Around 40% of this debt must be repaid or reborrowed in the next couple of years, as in they are maturing by 2027. So in short, central banks are feeling huge risk and financial stress for governments and corporations. So this rally isn't built on speculation. It's built on fear, inflation, and a quiet shift of trust. Gold versus equities, what history really says. Now people often ask, but gold doesn't give returns like stocks, right? Well, look at the numbers our team carefully analyzed to give you a clearer perspective. If you go back 25 years, gold has delivered an annualized return of around 10.5% in USD terms. You know what? That's higher than global equities in many emerging markets and even higher than in the developed ones. Here's the comparison of gold versus equity market return of developed versus emerging markets in local currency. In fact, over the last 2 decades, gold has actually outperformed equity indices in several developed markets. In emerging markets like Brazil or South Africa, the story is mixed. Equities did better at times, but with far more volatility. In India, interestingly, gold and equities have performed almost neck and neck, both returning roughly over 13% CAGR in the long term. Which means gold hasn't been dead money. It's quietly matched stock market returns and often with less pain along the way. That's what makes this moment so fascinating. When an asset with that kind of long-term record is also being hoarded by central banks, it tells you something about the underlying anxiety in the system. Gold versus inflation, the timeless hedge. Now let's talk about inflation because that's where gold's real reputation comes from. Historically, gold has acted as a hedge against inflation. Whenever inflation spikes, gold tends to protect purchasing power. Take the last few decades. Between 2000 and 2025, global inflation averaged around 2.5% a year. Gold during the same period grew by 10.5%. And here's something interesting. Even in periods where inflation cooled off, gold didn't crash. It simply consolidated. When people stop trusting governments, currencies, or even the stock market, they run to gold. And nowhere is that trust relationship stronger than in India. India's obsession with gold, the world's biggest private vault. Let's put this in perspective. According to the World Gold Council, Indian women alone hold over 25,000 tons of gold. That's roughly 12% of all the gold ever mined in human history and this is greater than the gold reserves of the US, Germany, Italy, France, Russia and China combined. Another way to put this is, if you melt that down, the value crosses $3.2 trillion, more than the GDP of countries like Canada and Switzerland combined. That's not just culture, that's a macro force. Every time prices fall, millions of households in India step in to buy. And every time prices rise, they feel wealthier, which in turn fuels consumption. And as income rises, this base of demand gets stronger. Should you now invest in gold? Now comes the real question. Should you invest in gold right now when it's already at an all-time high? Let's be honest. Predicting short-term moves in gold is nearly impossible. But here's what we can say with clarity. The drivers behind this rally are still intact. Central banks are still buying. Global inflation, while moderating, is far from dead. Geopolitical risks haven't gone away. So yes, the case for owning gold remains strong. But, and this is crucial, the margin of safety is thin. You shouldn't expect another big jump in the next 6 months just because it's been rising lately. Instead, think of gold like insurance, something that protects your wealth when other things go wrong. The right allocation for most investors is around 5 to 10% of the total portfolio. Enough to protect, not enough to distort. Now let's get practical. How do you actually invest in gold, and which route makes the most sense? Let's break it down. First, physical gold the traditional way. This could be jewelry, coins or bars. While it's tangible, emotional and accepted anywhere, the high making charges, GST, purity issues and theft risk make it slightly unattractive as an investment route. And tax-wise, it's not great. Any gains are taxed as capital gains and short-term profits get clubbed with your income. Second, gold ETFs and gold mutual funds, the modern way. These are digital versions of gold. You buy units that represent gold stored safely by the fund. The pros are, there are no making charges, it's easy to buy and sell, it's fully transparent and it tracks gold prices accurately. Returns mirror the gold price. And taxation is the same for both ETFs and gold mutual funds. If you plan to trade or hold for 2 to 3 years, this is a clean, efficient route. Third, sovereign gold bonds or SGBs, the smartest long-term play issued by the Government of India. They pay 2.5% interest per year and give you exposure to gold prices. Hold them till maturity and your capital gains are tax-free. The only catch? They lock you in for 8 years, though you can exit after year 5 in secondary markets. Here's an important update though. There are no fresh issues currently. The last issue was SGB 2023-24 Series 4. But you can still buy SGBs through the secondary market. But liquidity, price premium or discount and interest accruals must be assessed carefully. Here's a table that summarizes everything for you. What to keep in mind. Let's wrap this up with what most people forget. Gold is not a bet on prosperity. It's a bet on uncertainty. It doesn't create value, it protects it. So if you're buying gold, buy it for peace of mind, not FOMO. If the world calms down and markets rally, your gold might underperform and that's okay, because it means your other assets are doing well. If things go wrong, your gold will likely hold up better, and that's exactly the point. So yes, gold at all-time highs still makes sense if you understand what you're buying. You're not buying a precious metal, you're buying trust. You're buying time when the world panics. And in uncertain times like these, that must just be worth its weight in gold. You know what? थोड़ा सा और ऊपर no मतलब नीचे बस this side premium discount and the interest accruals no sorry and interest accruals isn't it too late?
नहीं India is like the थोड़ा dramatic.
ठीक है हो जाएगा फटाफट अभी. We just started. Let us know in the comments.
Lettuce, burger.
Cool. That's it.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.